Picture the setup on a trading desk right now. You are staring at your terminal, and a company steps up to the microphone for their earnings call.
Right.
And the numbers just start flashing across the screen. Fourth quarter revenue growth comes in at 1,985% year over year.
Which is just an absurd number to see in print.
It is. You honestly read that twice to make sure it isn't a typo. Then the sequential growth hits, right? Yeah. 172% from just the previous quarter.
Yeah, that sequential jump is almost more impressive than the year over year.
Exactly. And then you look at the balance sheet. Over the last 12 months, their cash position hasn't just grown, it has completely mutated from a modest $9.2 million into an absolute war chest of $167.9 million.
I mean, if you were building a financial model in a vacuum, those metrics look like the ultimate defense tech bull dream.
Oh, absolutely.
You have hyper growth on the top line, a fortified balance sheet that completely removes, the immediate threat of shareholder dilution.
Which is huge for small caps.
Right, it's massive.
Yeah.
And they have a clear operational tempo. In a rational environment, you expect the stock to gap up violently at the opening bell.
You expect a short squeeze, honestly. You expect analysts just scrambling to upgrade their price targets. But what actually happens at the next regular session close?
It drops.
The stock drops roughly 11%. It settles down at $15.14. And this was not a quiet, low liquidity drift downward either.
No, it's heavy.
Very heavy. Volume spiked 61% higher than the average daily volume. We're talking about massive, aggressive institutional distribution here.
Yeah, and if you look under the hood at the options market, it gets even crazier.
Right, the derivatives.
Total volume for both puts and calls hit 204% of the 20-day average. The derivatives market was screaming.
Just absolutely losing its mind.
Exactly. That kind of options volume tells you that market makers and institutional volatility traders weren't just passively selling off. They were aggressively hedging tail risk in both directions.
Like they had no idea what was going to happen next.
There was a fundamental breakdown in how the market was interpreting the future of this company.
Well, welcome to the deep dive. Today, we are focusing squarely on unpacking the Q4 and full year 2025 earnings results of Red Cat Holdings, ticker symbol RCIT.
A fascinating one to dig into.
It really is. And we are operating purely as a professional earnings call summarization desk today. So we're dissecting the numbers, the strategy, and like we just said, the glaring disconnect between management's narrative of a transformative year and the market's incredibly swift, punishing reaction.
Because the central tension here is the classic standoff between strategic, physical ambition and cold, hard financial reality.
Yeah.
You have blindingly good top-line numbers, but the underlying mechanical reality, so the profit margins, the bottom-line earnings, and the future revenue visibility, that is what triggered that 11% haircut.
So before we go down the rabbit hole of drones and defense procurement and factory floors, we really need to lay out the raw result snapshot. We have to set the baseline for you.
Right, the actual prints.
Exactly. For Q4, revenue came in at $26.2 million. That absolutely crushed the street consensus, which was hovering around $24 million.
A solid beat.
Yeah. And for the full year of 2025, revenue hit $40.7 million. But this is exactly where the armor starts to dent.
This is where it gets messy.
It does. GAAP EPS came in at negative 17 cents, which missed the analyst consensus of, negative 14 to negative 15 cents.
Right.
And adjusted EBITDA, which management heavily highlighted on the call, was negative $17.8 million for the quarter and negative $51.3 million for the entire fiscal year.
Which is a heavy burn.
Yeah. A very heavy burn. And then we get to the metric that seemed to trigger the algorithmic selling. Q4 gross margin stood at a razor-thin 4.2%.
Yeah, that gross margin figure is the center of gravity for the entire bearish argument.
It has to be.
It is. When institutional investors evaluate a hardware company, especially in the defense sector, they are hyper-focused on the path to profitability.
Because it's not software.
Exactly. Software companies can run at negative margins for years because their distribution costs are essentially zero. You just copy the code.
Right, you send a download link.
But hardware is entirely different. You have to build the machine, pay for the raw materials, staff the assembly line. I mean, a 4.2% gross margin implies that they are practically handing these drones out at cost.
Let's dig right into that margin dilemma because we have to bridge the gap between 26 million in quarterly revenue and that sub 5% margin.
And it was even worse for the full year.
Oh yeah, the full year 2025 gross margin was 3.1%.
Just brutal.
Now, I look at those numbers, and my immediate instinct is to compare this to a classic Web 2.0 startup from 15 years ago.
Oh, the old growth at all costs model.
Exactly. You know the playbook, selling dollar bills for 95 cents just to acquire users, assuming you'll just figure out how to monetize them a decade later.
Right.
How on earth can a physical hardware manufacturing company sustain a negative $51 million adjusted EBITDA just to capture market footprint?
Well, if they were operating like a Web 2.0 consumer app, they couldn't.
They'd be done.
They would be bankrupt by Thanksgiving.
Mm-hmm.
But the mechanics of scaling defense hardware require a massive upfront physical capitalization phase that severely distorts the income statement.
Okay, break that down for me.
To understand that 4.2% margin, you have to look at what actually goes into cost of goods sold, or COGS, on a manufacturing floor.
Right, because COGS isn't just the plastic, the carbon fiber, and the microchips, is it?
It's exactly the opposite, actually. In early stage manufacturing, your direct materials might be cheap, but your fixed manufacturing overhead is massive.
Like the facility itself.
Right. Imagine you lease a huge warehouse, you install millions of dollars of custom tooling, testing chambers, assembly jigs, and you hire a highly specialized floor manager.
Yeah.
All of those costs get amortized into the COGS of the units you actually produce. So if that factory is capable of producing 10,000 drones a month, but you only have the orders to produce 500,
Oh, wow.
those 500 drones have to absorb the fixed costs of the entire empty factory.
So they are bleeding cash on this massive footprint because they just don't have the volume yet to achieve what manufacturing engineers call overhead absorption.
Exactly.
The factory rent and the electricity bill, they cost the exact same whether they build 1 drone or 1,000 drones.
That is the mechanical reality driving the margin compression here. And it extends far beyond the factory floor into the broader operating expenses, too.
Yeah, I saw that.
Looking at the results, operating expenses doubled year over year. They exploded from $32.9 million to $67.8 million.
That is a massive jump.
It was driven by an 85% increase in headcount. And they aren't just hiring line workers, They are hiring aerospace engineers, software developers for artificial intelligence, and corporate infrastructure to manage a much larger organization.
Which is expensive talent.
Extremely. R&D spend alone more than doubled to $17.9 million.
Wait, I want to pause on that R&D number, actually. Yeah. $17.9 million is a massive chunk of change for a company that generated $40 million in total revenue for the year.
It's almost half their revenue.
Exactly. That isn't just iterative testing on battery life. That suggests they are fundamentally rebuilding or expanding their entire technological base.
They are. They are attempting to transition from being a niche vendor of small drones to becoming an at-scale defense prime contractor.
Okay, so a whole different league.
A completely different league. That requires building proprietary, secure communication links, integrating machine learning algorithms for autonomous target recognition, and ensuring their systems can talk to other U.S. military assets across air, land, and sea domains.
Which is not cheap.
Not at all. So the core question for anyone modeling this stock is simple, right? Is a 4% margin a permanent structural ceiling?
Meaning, are their supply chain costs simply too high to ever make a profit?
Exactly. Or is this a temporary Trava valley of death they have to cross before economies of scale kick in?
But see, if you are bleeding cash to build that kind of infrastructure, you desperately need guaranteed future revenue to keep the lights on and justify the burn rate.
Right. You need visibility.
Yes. Yet when analysts on the call asked for that guarantee, when they asked for any formal FY 2026 guidance, management gave them absolutely nothing.
Nothing at all.
They withheld it entirely.
And that refusal to provide forward guidance is the primary catalyst for the stock dropping 11%.
It has to be.
The market can forgive terrible margins today if the management team can credibly promise 30% margins next year based on a signed backlog.
Sure.
But institutional investors have a deep fundamental hatred of contract timing risk.
They despise it.
When an analyst at a hedge fund runs a discounted cash flow model to value a stock, the entire mathematical foundation of that model relies on projected cash flows.
Right.
If management says, we don't know exactly when the revenue is coming, the analysts have to dramatically increase the discount rate.
which just slashes the present value of the stock.
So the model breaks,
Right.
the risk premium spikes, and the portfolio manager hits the sell button.
Management's rationale for withholding that guidance is fascinating, though, from a psychological and operational standpoint.
That was very telling.
They essentially cited PTSD from last year's continuing resolution delays in Congress. They outright refused to issue forward-looking numbers until government contracts are physically signed and the ink is dry.
Which is a completely rational defense mechanism if you understand how broken the Department of Defense procurement cycle is right now.
It is notoriously bad. Let's talk about that.
Yeah, a continuing resolution, or CR, is a legislative stopgap. When Congress fails to pass a formal budget by the end of the fiscal year, they pass a CR, which legally restricts government agencies to spending at the exact same levels on the exact same programs as the prior year.
So wait, if a defense contractor develops a brand new cutting-edge drone system and the Pentagon desperately wants to buy it, they literally cannot legally write the check if the government is operating under a CR.
They cannot. The Anti-Deficiency Act prevents government officials from authorizing expenditures that haven't been appropriated.
Wow.
Yeah, New START programs are explicitly forbidden under a CR. So if Red Cat's management goes out and promises Wall Street $100 million in revenue based on a handshake agreement with the Pentagon.
And then Congress gets deadlocked for 6 months.
Exactly. The revenue doesn't materialize, the company misses its quarterly estimates, and the stock gets annihilated anyway. They are choosing to take the credibility hit now rather than setting a guidance trap for themselves later.
But the tension is palpable because we actually got a glimpse of the whisper number during the Q&A segment of the call.
You did, yeah.
Management acknowledged that sell-side analysts have estimates ranging wildly. I mean, from $100 million all the way up to $170 million for the coming year.
It's a massive spread.
And management specifically noted they are very comfortable in the top half of that range. Let's process that for a second. They generated $40 million this year. They are comfortable with estimates hinting at roughly $135 to $170 million next year, but they refuse to formally commit to it.
It creates a massive volatility vacuum. The market hates uncertainty more than it hates bad news.
But let's look at the macro environment right now. The U.S. government budget is now finalized for 2026.
Right, the money is there.
It includes an extra $150 billion plus another $50 billion earmarked specifically for Iran-related contingencies. The money is legally authorized and sitting in the Treasury.
Yes, it is.
Is management being overly paranoid here? Or does the actual mechanics of moving money from the Treasury to a mid-cap defense contractor's bank account really just take that long?
The plumbing of DoD procurement is notoriously slow.
Even with an approved budget.
Even after the president signs the budget, yes. The money has to be apportioned to the specific military branches, then allocated to the specific program offices.
Okay.
Then the contracting officers have to draft the requests for proposals, evaluate the bids, and award the contracts. Even if a company has already been down-selected as the winner of a program, the administrative process of getting a funded contract obligation can take months.
Jeez.
Management knows that winning a competition and getting paid are two entirely distinct events in the defense sector.
Wait, so if they are building these massive factories without signed contracts in hand, they aren't just taking on timing risks, they're basically front-running the Pentagon.
They absolutely are.
They are betting the DoD will have no choice but to buy from them because they'll be the only ones with the physical inventory ready to ship. Is that a stroke of strategic genius or just incredibly reckless capital allocation?
It is the defining gamble of their corporate strategy. They are operating under the philosophy that the factory is the weapon.
The factory is the weapon. That's a great phrase.
It's how you have to think about it. In modern industrial scale conflict, having the best technology doesn't matter if you can only build 10 of them a month.
Right, because they just get blown up anyway.
Exactly. The ability to surge production, to replace battlefield losses in real time, is a strategic deterrent in itself.
And the scale of what they are building is staggering. We aren't talking about leasing a slightly larger warehouse down the street. They are expanding their physical footprint from 36,000 square feet to a massive 254,000 square feet across facilities in Utah, Florida, Georgia, and California.
It's a massive footprint.
Think about the logistics of that. That is like building an 8-lane highway in the middle of the desert because you know a massive metropolitan city is going to be zoned there next year.
Right.
If the city gets delayed, you go bankrupt maintaining the empty asphalt. If the city gets built, you own the only toll booth in the region.
To understand the capacity of that toll booth, we
Yeah.
really need to look at the specific production metrics management provided.
Yeah, let's look at the numbers.
At their Salt Lake facility, they're currently producing 50 Black Widow drones a day.
Okay.
But the critical piece of information is that they have a clear path, the physical floor space, and the supply chain mapped out to hit 1,000 drones per month, running just a single shift.
1,000 a month.
Yes. And over at their Torrance facility, known as Flightway, they are producing 125 Edge 130 drones a month.
Right.
And the crucial detail there, they're only utilizing 33% of that facility space.
33%. Why build that much excess capacity? What is the demand signal they are seeing that Wall Street is missing?
The demand signal is entirely legislative, and it's called NDAA Section 1709.
Okay, break that down for us.
The National Defense Authorization Act is the annual bill that funds the military. Section 1709 is not some minor regulatory footnote. It is a sweeping structural ban prohibiting the U.S. military and eventually all federal agencies from procuring Chinese-manufactured unmanned aircraft systems.
Okay, so a total ban.
Specifically, it targets companies like DJI, which previously dominated the commercial and low-cost tactical drone market.
Let's drill down into why that ban exists, though, because it isn't just a protectionist trade policy to boost American manufacturing, right?
No, not at all. It is fundamentally about data security and operational security.
Right.
Commercial drones made by foreign adversaries are essentially flying cell phones. They have cameras, GPS receivers, and radio transmitters.
Everything you need to track someone.
Exactly.
Yeah.
The Pentagon realized that when U.S. soldiers were flying these cheap, off-the-shelf drones for reconnaissance, the flight logs, the telemetry data, and potentially the video feeds were being routed through servers located in Shenzhen.
Which is terrifying if you think about it.
It was a massive counterintelligence vulnerability. The DoD was essentially mapping its own bases and troop movements and handing that data to a geopolitical rival.
So the U.S. government drops the hammer, bans the Chinese hardware, and suddenly every platoon, every base security force, and every federal agency that relied on those cheap drones is just left empty-handed.
Left with nothing.
It creates an instantaneous vacuum in the supply chain.
Exactly. The DoD can no longer just buy a $2,000 commercial drone off the internet. They need domestic, secure, NDAA-compliant supply chains.
And building that is hard.
It's a nightmare. You can't just assemble the drone in Utah. You have to ensure the microcontrollers, the brushless motors, the secure radio links, and the camera gimbals are all sourced from allied nations.
Which perfectly explains their inventory strategy.
Yes.
During the earnings call, it was revealed that they built up their inventory from $13.6 million to $30.4 million.
That's a huge jump in parts.
That is a massive amount of capital tied up in parts sitting on shelves. They're stockpiling NDAA-compliant components because they know that when the DoD finally gets their budget unlocked, the military won't want to wait 12 months for a manufacturing run.
No, they'll want them immediately.
Right. The military will want the drones delivered on Tuesday.
But, carrying $30 million in inventory in the tech sector carries massive risk.
Oh, for sure.
Drone technology moves at the speed of software. Batteries degrade if they sit too long.
You can't just leave a lithium battery on a shelf for 3 years.
Exactly. Camera sensors become obsolete in 18 months. Radio frequencies get updated. If they are holding 30 million in parts and the DoD procurement cycle gets delayed by 2 years, they might be forced to write down a massive chunk of that inventory.
But they can afford to play this game of chicken because of that balance sheet mutation we talked about at the beginning.
Right, the war chest.
They are sitting on $167.9 million in cash. They don't have to go back to the capital markets to fund this inventory build.
Which is such a luxury.
It is. They don't have to issue a secondary offering and dilute the shareholders just to keep the lights on while they wait for the Pentagon to act. They have the runway to outweight the bureaucracy.
The cash is their defensive moat. It allows them to aggressively scale their operations, not just domestically, but internationally.
Right.
And while they're waiting for the massive U.S. defense contracts to formalize, they are pointing all of this manufacturing capacity at the most urgent demand signal on the planet right now, which is the front lines of Eastern Europe.
Ukraine has absolutely become the ultimate proving ground for this technology. Management revealed on the call that they have officially established a new office in Kyiv.
Not just an office either.
Right. The executive team, including the chief operating officer, didn't just take a diplomatic trip. They were physically present in Ukraine, testing equipment directly alongside warfighters.
There is no substitute for live fire validation.
None.
You can test a drone in a wind tunnel or over a desert in Utah. But until it is flying in an environment saturated with military-grade electronic warfare, you don't actually know if your product works.
And that physical presence led to a major catalyst. Management disclosed they received a formal letter of request, an LR, from Ukrainian forces to begin replacing their existing fleet of Chinese-made ISR drones.
And ISR, for context, stands for Intelligence, Surveillance, and Reconnaissance.
Right, these aren't the exploding ones.
Exactly. These are the drones that go up, spot the artillery targets, map the trenches, and stream the video back to command.
And during the Q&A segment, a metric was casually dropped that completely alters the scale of this market. Do you remember the consumption rate management quoted for Ukraine?
It is the kind of number that forces you to recalibrate everything you know about modern warfare.
It really is.
Management stated that Ukraine is burning through 350,000 Chinese ISR drones a year.
Let that sink in for a second. 350,000 aerial vehicles destroyed, lost, or rendered inoperable every single 12 months.
It's almost 1,000 a day.
It's incomprehensible.
To understand why that burn rate is so astronomically high, you have to understand the mechanics of electronic warfare, or EW.
Okay, explain that.
In traditional conflicts, an aircraft might be shot down by a surface-to-air missile. In Ukraine, drones are largely being defeated by invisible electromagnetic spectrum attacks.
Jamming.
Jamming, exactly. Russian EW units deploy massive jammers that sever the radio control link between the pilot and the drone, or they spoof the GPS signals, convincing the drone it is in the middle of the ocean so it automatically attempts to land.
Wow.
The lifespan of a commercial off-the-shelf drone on the front lines can sometimes be measured in hours, not months.
So Ukraine is forced to treat these drones like ammunition.
Yes.
You fire them, you expect them to be lost, and you reach into the box for another one, which is why Red Cat entering into a joint development agreement, a JDA, with a Ukrainian state-owned partner is such a pivotal milestone.
That JDA is arguably the most important strategic development discussed on the call.
Really? More than the U.S.
In
contracts.
terms of tech validation, yes. It is incredibly rare for a non-governmental mid-cap commercial entity to secure a direct joint development agreement with a foreign state-owned defense enterprise during an active conflict.
What are the actual mechanics of that JDA, though? It can't just be a standard vendor-client contract where they ship boxes of drones and collect a check.
No, it is a symbiotic two-way data exchange.
Okay.
On one side of the equation, Red Cap provides the Ukrainian forces with highly secure NDAA-compliant hardware that is exponentially harder to jam than the commercial drones they are currently using. On the other side of the equation, Red Cat gets direct access to the battle-proven telemetry and EW data. When one of their drones encounters a new Russian jamming frequency, that data is captured, analyzed, and integrated back into the software of Red Cat's entire fleet.
Which means they're extracting the most valuable commodity in the defense sector right now, real-world combat data.
It's priceless.
They are using the conflict to train their algorithms. When they go back to the Pentagon to pitch their systems to the U.S. military, they aren't just selling a drone. They are selling a drone vaccinated against the exact electronic warfare tactics currently being deployed by near-peer adversaries.
Exactly. That feedback loop makes their domestic U.S. fleet infinitely more lethal and survivable.
If you're sitting there crunching the numbers on this total addressable market, you realize pretty quickly that capturing even a fraction of that demand completely breaks their current valuation model.
Let's do the math on it.
Yeah, let's run it. If Ukraine is burning through 350,000 drones a year, and Red Cat manages to capture just 5% of that replacement cycle, that is 17,500 drones.
Right.
Even if we assume a highly conservative, heavily discounted price point for bulk government orders, you are looking at hundreds of millions of dollars in potential recurring revenue. For a company that generated $40 million total last year, that isn't just growth. That is a fundamental phase shift in the business.
It forces a complete recalibration of their revenue multiple.
He does.
But if you think the aerial drone market is massive, we have to look at where the company is deploying its heaviest capital investments right now.
The maritime shift.
The drone war isn't staying in the sky. It is rapidly moving to the water, and this multi-domain pivot is where the narrative shifts from being a niche supplier to a structural defense prime.
We need to talk about their Blue Ops Maritime division. Management detailed a $30 to $40 million capital investment specifically to operationalize this division.
It's a massive bet.
They didn't just hire a few naval architects either. They went out and leased a 155,000 square foot boat factory in Georgia. Their stated operational goal is to produce over 100 uncrewed surface vessels, or USVs, in 2026 alone, with the first deliveries targeted for the second quarter of 2026.
Moving from aerial drones to maritime surface vessels is a massive leap in engineering complexity.
Because of the environment.
Exactly.
Yeah.
An aerial drone operates in a relatively predictable medium. A maritime vessel has to survive saltwater corrosion, extreme wave action, massive thermal fluctuations, and extended endurance missions lasting weeks at a time.
Right. Saltwater destroys everything.
It really does. To bridge that capability gap, they partnered with Hodgson Shipbuilding.
Which is a brilliant maneuver. They aren't trying to learn how to bend steel and fiberglass from scratch.
No need to reinvent the wheel.
Exactly. They are taking proven legacy shipbuilding expertise and mating it with their proprietary autonomous flight software and secure communications architecture. They are building what they refer to as the Variant 7 hull.
And the modularity of that Variant 7 hull is where the lethality comes in. They aren't just building an autonomous boat to drive around and look at things.
No, these are armed.
Yes, they are integrating highly kinetic payloads. For short-range threats, they've integrated the ACS Bullfrog system.
Let's explain what the Bullfrog actually does, because it sounds like science fiction.
It really does.
The ACS Bullfrog is an automated, stabilized turret designed specifically for kinetic defeat against incoming FPV drones and larger loitering munitions, like the Shahed drones we see being used so frequently.
Right.
It uses advanced targeting algorithms to track a drone moving at high speed and physically shoot it out of the sky up to 1,500 yards away.
Which is incredible.
And for longer-range engagements, they are integrating the Eon Zeus system, which can reach out and engage targets up to 20 kilometers away using directed energy or advanced kinetic interceptors.
When you combine an autonomous surface vessel with those kinds of kinetic payloads, you fundamentally change the strategic map.
You do.
Management explicitly highlighted specific geopolitical hotspots where this technology is immediately relevant. We're talking Venezuela, the U.S. Virgin Islands, the Gulf of America, Cuba, and perhaps most urgently, the Strait of Hormuz.
The Strait of Hormuz is the perfect, terrifying analogy for why the economics of asymmetric warfare are breaking the traditional U.S. Navy.
Let's talk about that.
The Strait of Hormuz is a massive choke point for global energy markets. To protect a commercial oil tanker moving through that narrow body of water today, the U.S. Navy might be forced to deploy a billion-dollar Aegis destroyer.
And an Aegis destroyer is an exquisite, highly complex asset.
Exactly.
It carries hundreds of American sailors, and its primary defense mechanisms are interceptor missiles that can cost $2 to $4 million each.
Right. So imagine adversaries launching a swarm of 50 cheap autonomous explosive drones, each costing maybe $10,000 at that tanker.
The math breaks down immediately.
It does. The destroyer has to use multi-million-dollar missiles to shoot down $10,000 drones. The cost exchange ratio is completely inverted. The adversary can bankrupt the defender simply by attacking.
It's unsustainable.
Why risk that billion-dollar asset, and why bleed your missile inventory when you can deploy a swarm of 40 autonomous USVs acting as a kinetic shield around that commercial tanker?
The economics are undeniable. If an adversary launches a drone swarm, your autonomous USVs, equipped with those Bullfrog turrets, form a defensive perimeter and engage the threats using cheap kinetic ammunition.
Right.
If one of your USVs takes a hit and sinks, you have lost a relatively inexpensive piece of hardware, but 0 human lives are lost, and the commercial asset survives. This concept of attritable mass is taking over Pentagon doctrine.
And tying this back to the revenue model, the geographic expansion is enormous. Management explicitly noted on the call that aerial platforms, by definition of the landmass, only cover 30% of the Earth.
Right, the rest is water.
By moving aggressively into the maritime domain, they're suddenly addressing the other 70%. It transforms the total addressable market. The company ceases to be just a drone vendor and elevates into a family of systems defense contractor capable of providing integrated air and sea networks.
So how does this grand strategy fit into the immediate domestic procurement reality? Everything we have discussed, the massive factory scaling, the brutal data validation in Ukraine, the maritime USV build-out, is positioning the company for the Department of Defense's massive drone dominance initiative.
Now, in the spirit of objective analysis, we have to address a significant reality check that management provided on the call.
Yeah, the gauntlet miss.
They openly admitted that they did not make the cut for Gauntlet 1 of the drone dominance program. On the surface, if you are a retail investor reading a headline, failing to advance in a major DoD drone program sounds like a disaster.
It would be a disaster if you don't understand the ecosystem mechanics of modern drone warfare.
Right. Explain the ecosystem.
The total award for the drone dominance program is massive. It is seeking to procure up to 350,000 FPV drones.
And FPV stands for first-person view.
Right. These are the highly maneuverable, kinetic, exploding drones that the operator flies using video goggles. They are essentially precision-guided loitering munitions.
But based on the brutal battlefield data observed over the last 2 years in Ukraine, we know that these systems do not operate in a vacuum.
No, they don't.
Modern drone warfare operates on a strict, mathematically proven ratio. For every 20 FPV shooter drones you deploy to the front lines, you need exactly one ISR sensor drone hovering high above the battlefield to find the targets and relay the coordinates.
Let's break down why that 20-to-1 shooter-to-sensor ratio exists.
It's because it's a huge point.
It is. An FPV drone is designed for speed and impact. It flies extremely low to the ground to avoid radar, which means its radio communication line of sight is severely limited by trees, buildings, and terrain. Furthermore, the camera on an FPV drone is narrow and focused forward. It is basically a blind bullet once it gets low.
You can't hunt for a camouflaged tank using a drone flying at 60 miles an hour 3 feet off the ground.
Precisely. You need an ISR drone, like the Black Widow, loitering thousands of feet in the air.
The eyes in the sky.
Yes. The ISR drone has high-definition thermal optics, a wide field of view, and highly secure communication links. The ISR drone spots the target, calculates the exact GPS coordinates, laser designates the area, and acts as a high-altitude radio relay node, bouncing the signal from the operator on the ground down to the FPV drone.
Wow.
The FPV drone cannot hit the target without the ISR drone acting as the quarterback.
So if we run the math on the DoD's procurement goal, if the Pentagon is buying 350,000 FPV shooters, the operational doctrine dictates they must also procure roughly 17,500 ISR sensor drones, which falls into the short-range reconnaissance category.
And this is the strategic pivot management is executing.
Ah.
They are positioning the Black Widow drone strictly as the indispensable sensor in this equation. So even if they lose the primary FPV contract, even if they miss every single gauntlet for the kinetic shooters, they're positioning themselves to be the required eyes for whoever does win the larger contract.
That's fascinating.
The entire ecosystem requires the sensor to function.
Which brings us to the broader sector context and how the market is digesting all of this complexity. Let's look at the trailing returns, because the 11% after-hours drop doesn't tell the whole story.
It really doesn't.
Over the trailing one-year period, Red Cat's stock is up an astounding 153.3%. Let's compare that to the broader benchmarks. The Aerospace and Defense ETF, ticker ITA, is up 43.5% over the same period.
Right.
The S&P 500, represented by the SPY, is up roughly 15.7%.
That massive triple-digit outperformance over the trailing 12 months reveals the underlying investor psychology.
They want to believe.
The market desperately wants to believe this thesis. Institutional capital wants to fund the disruption of legacy defense primes. They want to believe in the transformation from a niche vendor to a multi-domain prime contractor.
Odd.
But at these elevated valuation levels, after a 150% run, the market is no longer paying for the story.
No.
They're demanding flawless mathematical execution. The grace period for narrative-driven growth is officially over. The market is demanding signed contracts and margin expansion.
Which perfectly frames the core tension we have explored throughout this entire deep dive. You have a company posting record-breaking top-line growth of nearly 2,000%.
Unbelievable growth.
You have a massive physical footprint expansion across 4 states, an undeniable geopolitical tailwind forcing the adoption of domain technology, and a balance sheet bursting with cash.
Right.
But it is violently colliding with zero formal revenue guidance for the coming year and a 4.2% gross margin that suggests they are barely covering the cost of keeping the factory lights on.
It is the ultimate test of conviction for anyone holding the stock.
Which brings us to the final segment of the show. We have dissected the earnings report, we have debated the macro strategy, we have explored the physics of drone warfare, and now it is time for the "This is not financial advice" segment.
My favorite part.
As always, a strict reminder, everything discussed here is purely educational, highly hypothetical, and designed for high-level strategic analysis. Imagine we are two analysts at a macro hedge fund pitching wild but plausibly structured trade ideas to the investment committee. We are absolutely not telling you, the listener, what to buy, hold, or sell.
I'll bite. What is the pitch to the committee based on this earnings setup?
Trade idea number one. I am calling this the guidance arbitrage straddle.
Okay, I like the name.
The thesis is entirely built around the volatility vacuum management just created. We know they are actively waiting on the ink to dry for major government contracts. They explicitly promised on the earnings call that they will not wait for the next quarterly reporting cycle to update the market. They said they will release guidance as soon as the contracts are secured.
Which means a major market-moving catalyst could happen completely out of cycle.
Exactly. A sudden PR drop with formal 2026 guidance could happen on literally any random Tuesday morning at 8 o'clock. The options market is already pricing in massive uncertainty, trading at over 200% of normal volume.
A market knows something is coming.
The market knows a binary event is imminent, so I am pitching a long calendar straddle or perhaps a heavily skewed call spread to capture this out-of-cycle guidance drop.
Explain the mechanics of how that protects the downside for the committee.
If you buy a straddle, you are buying both a call option and a put option at the exact same strike price. You are betting purely on an explosive move in either direction. If the margin compression continues to drag the stock sideways and the DoD bureaucracy delays the contracts for another 6 months, the stock likely bleeds slowly, and your downside is strictly defined by the premium you paid for the options.
Okay.
But if they suddenly announce on a Thursday morning that they have secured a $150 million funded backlog, the upside captures an immediate, violent re-rating of the stock. You are arbitraging the silence.
It is a textbook event-driven volatility play. You are isolating the contract timing risk and trading the eventual resolution. I like the structure. Let me pitch trade idea number 2 to the committee.
Let's hear it.
I call this the multi-domain pairs trade. This isn't an event-driven play. This is a structural, macroeconomic thesis designed to play out over the next 3 to 5 years.
A pairs trade usually involves going long on one asset and shorting a correlated asset to eliminate broader market risk. How are you structuring it?
You go long on a basket of agile, NDAA compliant, hardware scaling small caps companies, exactly like the one we've analyzed today, that are building autonomous, attritable systems.
Okay, and the short.
Simultaneously, you take a short position against a legacy, slow-moving maritime defense prime. The massive corporations that rely entirely on multi-billion-dollar, decade-long shipbuilding contracts.
So you are basically taking the Aegis destroyer versus the autonomous drone swarm analogy we discussed earlier and turning it into an equity trade.
Exactly. The thesis here is that the economic realities demonstrated in the Strait of Hormuz and the Black Sea are going to permanently force the Pentagon to shift capital expenditure.
They have to.
The Department of Defense simply cannot afford to keep defending $50 million commercial assets with vulnerable billion-dollar ships that take 5 years to build. The DoD budget is going to structurally rotate away from massive, exquisite naval platforms and aggressively toward attritable, autonomous USV swarms.
Right.
By structuring it as a pairs trade, you capture the alpha of that capital rotation, regardless of whether the broader S&P 500 goes up or down. You're betting purely on the evolution of military doctrine.
That is a phenomenal macro thesis. The fundamental mathematics of warfare are changing, and the capital markets are eventually going to have to reflect that reality on the balance sheets.
They will have no choice.
If you are listening and building your own discounted cash flow models, you have to answer the hardest questions. How long do you think it will realistically take a 254,000 square foot factory to pull a 4% gross margin up into the mid-30s?
It won't happen overnight.
No. Can they outrun the fixed costs of that massive infrastructure before the cash pile burns down? Or will the Pentagon procurement cycle delay them into a corner?
It is the defining operational question for the company over the next 4 quarters.
As always, none of this is financial advice. We are just here to break down the complexities of the tape and the realities of the defense sector. But I want to leave you with one final provocative thought to chew on as you evaluate this space.
What's this?
If companies like this actually succeed, If they prove that a swarm of $50,000 autonomous surface vessels can effectively neutralize or replace the strategic deterrence of a $2 billion guided missile destroyer, what happens to the massive legacy shipbuilders that employ tens of thousands of workers across crucial congressional districts?
That's a massive political problem.
It is. Are we simply watching the birth of a new sector of agile drone manufacturers? Or are we quietly witnessing the dawn of a mass extinction event for the traditional defense industrial base?
Something to think about.
Thanks for joining us on the deep dive. We will see you on the next tape.